The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. Welcome to this week's episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that Feds need to know in 15 minutes or less. So whether you are a seasoned federal employee or whether you're just starting out in your career, or if you're a retiree, Fed15 has got you covered. Grab your coffee, kick back, and we'll tell you what you need to know but might have missed in the space this week. We are your hosts, Katelyn Murray, and I am joined by Mr. Dan Sipe, none other.
Hey, Katelyn, how are you? And actually, how are you? Because I know you were down near where Helene started pushing in. So we actually had an interaction and because you had to head to the basement. So how?
We did after last week's recording. Dan and I were wrapping up some stuff and the alert came through on my phone. And I momentarily couldn't remember if you actually do something during a watch or a warning. And Dan was like, yes. Katelyn, that one means go downstairs. And I was like, all right.
I'm such a dad.
Yeah. Luckily we didn't get too terribly much in destructive weather here, which we were grateful for. We did have a couple. So we got the spinoff tornado experience off of Helene, but we didn't get anywhere near the devastation that our neighbors to the south are experiencing. Western North Carolina in particular, not very far away, but very much hurting. So definitely want to be mindful of our friends and feds in that region, and also in Florida, in South Tampa, which Helene was the first tornado to hit South Tampa directly in over 100 years. So I know a lot of folks down that way are hurt in Georgia, Tennessee, South Carolina. So our hearts go out to those folks.
Well, you know me, Katelyn, I'm also a practical guy. So anybody who's listening to this, I'm going to ask you to do something. Pick a charity, don't care which one it is. Throw a couple of bucks. If we all do something, we're going to do a lot. And just might change the trajectory of how people's lives are going. This is a chance where we really need to show what's best in us, and what's best in us is looking out for each other. So that's my clarion call.
Definitely agree. Just make sure you vet your charity. Make sure it is legit. This, unfortunately, tragedies open up windows
Charity
for
navigator.
Bad behavior. So definitely make sure that your charity's vetted and legit, and try to help out however you can, however you're able to. So Absolutely. With that, moving into, today's episode, we have got a really exciting episode. Dan's going to talk with us first a little bit about something called the 62 factor. And if you are a long-term listener of the Fed15 podcast, of the FedLife podcast, if you read the Serving Those Who Serve blog at STWS.com, you have probably heard about the 62 factor. Very, very key in Fed retirement planning. And once we go over that topic, then we're going to dive into the stock market. We're going to be talking about the S&P 500, people.
Juicy stuff.
Yeah, and the possibility of a 0% return on your C fund.
You take that back right now.
10 years.
We'll see.
I mean, this isn't the Halloween episode, but we are in the month of October. So 0% return on your C fund for the next 10 years. That's some spooky stuff. So
gotcha.
Dan, talk with us a little bit about this 62 factor. What is that?
Sure.
And why is it so important?
This is my soapbox thing. That has been so for decades. The basic FERS formula is you get 1% for every year of service unless you are retiring at age 62 or later with at least 20 years of service. And then a magical thing happens. That 1% factor goes to 1.1. And that's a 10% bump for life. Now, for example, something to keep in mind. If you're married and you were going to be a right thinking person, leave a survivorship to your spouse, a full survivorship's 10%. Well, if you stay until 62, bump everything up, all of a sudden you got the 10% that you need put in there. So I keep more people in federal service than retention bonuses. And we do as an organization. When you come to our part twos, if you're telling us you're going out at 60, we're going to show you what it looks like to go at 62. We're not going to tell you can't, but we're going to make sure that you know it. It may seem like a minor thing, but it can significantly impact your retirement income over time. Okay. So quick recap. I'm sure everybody knows this, but just one more time. Under FERS, pension is going to be based on your high 3 earning years, or basically last high 36 months, or doesn't even have to be last. Because let's say you came up to Washington, D.C. for a detail and you worked here 4 years, and then you went to another area of the country and the locality pay was lower. Nope. It'll remember and you'll still get the higher one. So then you get that 1% versus 1.1. Now, Katelyn, I'm going to go off the res here a little bit. Right now on our website, there's an article that we put up that can show you how to get an extra year of service without staying a year longer just by using your sick and annual leave a certain way. Well, here's the really good news. That sick leave can't qualify you for retirement, but it can qualify you for the bump at 62. So head over to our blog, read this article because there's lots of good stuff in there, because I'm not going to take you through all the calculations because you've already put those out. Stay till 62, but also if you're going to read an article over there in addition, read the one where we show you how to get an extra year of service without staying a year longer, because how you manage your sick and annual leave. So I'll go ahead and break that there so folks can go over and get what they need on that. Katelyn, why don't you tell us about this thing about what might be coming down the road for the C Fund or the S&P 500?
Yes. So this is something that we have been talking about with our clients here at Serving Those Who Serve a lot. So basically, we have a really interesting situation in the market right now. If you keep up with financial news, if you are at all involved in that world, you probably have heard that the S&P 500 index is currently pretty overvalued. Yes. So estimates range from 98% to 162% as to how overvalued it is, but pretty much no one is in disagreement that it is currently overvalued. And the S&P 500 index is sort of like Bruce Wayne and Batman, right? He's Bruce Wayne, but he's also Batman. You got two names, right? The S&P 500 is similar. Its other name is the C Fund in your TSP. So you may not... Yeah, you may not know or be very concerned about the S&P 500, but I bet that most of our feds are concerned about the C Fund. Now, the underlying index for the C Fund obviously is that S&P 500. So we are talking about the same fund, the same threat, the same concern. So looking at that word, overvalued, another word for that would be a bubble, right? We've heard of these stock market bubbles that happen from time to time. You may have experienced them in your investing career. Robert Shiller is a Yale University expert who actually studies these asset bubbles. And in 2013, he actually won the Nobel Prize in economics for his research, particularly on stock price predictability over the course of several years. You may have heard, we probably all have heard, the kind of platitude or the statement or the saying that the stock market returns 10% every year. I can tell you, it's all over Instagram, right? You can earn 10% year over year. While predicting 1 year returns is almost impossible, what this Robert Shiller guy did that was so revolutionary, he figured out this thing called a CAPE, which stands for a cyclically adjusted price to earnings ratio.
Gosh, he really
We
is
also call
Batman.
it
He has a cape.
Yeah. Yeah, there you go. We also call it the Shiller PE. So this ratio has accurately predicted 10-year stock market returns. It's calculated by dividing the price of the S&P 500 index by the average earnings over 10 years. And that helps to smooth out some of the short-term volatility that we see that can make it so difficult to keep up with the market, right? Every day you see the market's up, the market's down. Compared to what? Compared to yesterday? Compared to last year? What are we comparing to? So digging into that Shiller PE ratio, currently the Shiller PE is 35.5, right? That is a lot higher than the historical average, which is around 16 or 17, a whole lot higher, right?
Sure.
Now, that's what indicates overvaluation. That's kind of where that word's coming from. While a market crash is possible and the risk appears elevated due to that overvaluation, timing the market can be really risky, right?
Oh, absolutely.
So we all remember March of 2020, early on in the COVID-19 pandemic, the concern that we all felt, the fear that we all felt. We had that really quick market correction. It was so fast that it doesn't even, authorities said that it didn't really register as a true correction because it was so quick.
Record-setting fast.
Yeah, it's the fastest dip we've ever had. Stocks fell almost 40% in a month. But they had rebounded by year end, and we didn't get the significant bear market until later in 2022. So basically looking at historical peaks of this Shiller PE, we see them happening 1902, 1929, 1937, 1965, 2000, possibly 2021. That
and
could
contrary
be a
to
peak.
popular opinion, I was not here for the 1902, 1929, 1937 ones.
True.
I know those are
But you
rumors.
remember those other ones.
Yes.
You definitely remember 2000, I bet. So
100%.
Yeah. So basically these peaks, and the reason that we say possibly 2021 might not be considered a peak if the Shiller PE continues to rise higher in the future. But typically what we see, the reason these peaks in the Shiller PE are so important is that following those peaks, market performance is really not favorable. Often what we see, particularly in the S&P 500, following those peaks is a period of double-digit years of either flat or down returns in the S&P 500. What that means, the most recent one was 2000 to 2012. What that means is that if you put $1 in 2000, you waited 12 years, you pulled it out in 2012, you'd have $1, you waited 10 years to get it. Doesn't sound like a good investment, does it? That's a concern. So remember when we're looking at this, right? We are talking specifically about the S&P 500, and a lot of Americans consider the S&P 500 to be synonymous with the market.
Sure.
Could not be further from the truth. When financial advisors talk about the market, they mean the global market, right? Of that, the US is only about 60%. And within the US, you've got large cap, you've got small cap, you've got mid cap. S&P would fall into the large cap category, so we're getting rid of small and mid. And then inside that large cap category, you've got growth stocks, you've got value stocks. The S&P 500 are just the top 500 largest US large cap growth stocks. So you can sort of see when you start with the global market and you drill down to what the S&P 500 actually is, there's a whole lot of other options that are out there to help you diversify and to kind of mitigate some of the risk of a prolonged S&P 500 pullback, if that is what we're seeing with the Shiller PE peaking. Now, there's been some additional analysis on this. Dr. Michael Fink, he showed that the CAPE ratio, the Shiller PE, effectively predicted 10-year returns, with 67% of actual returns falling within 1.37% of predictions and 95% falling within 2.75%. So if the CAPE predicted a 5% annual return, actual returns would be between 2.25% and 7.75%. So On the opposite side of that coin, when the Shiller PE is low, like around 10, remember that average is 16 or 17, that means that your expected annual returns can be larger, right? So we tell you all of this not to encourage you to market time, right? I said early on, market timing is really difficult. It is effectively impossible. I think market timing is the myth that leads lots of investors to sabotage themselves. We tell you this because the Shiller PE is a meaningful and useful factor when you are looking at long-term possibility for the S&P 500. And really the message here is diversification as a way to mitigate risk. So all of that stuff, when we talked about what the S&P 500 actually is, all that stuff that we were cutting out, small cap, mid cap, value, international, all of those are your diversifiers that can help you dampen the impact of a prolonged S&P 500 pullback, a prolonged C fund pullback. So in your TSP, what that means is looking at things like the S fund, looking at things like the I fund, reevaluate that F fund. That interest rate cut has the F fund looking a little bit better than she's been looking lately. Definitely take a look at that. We've got an article on the blog piece that I wrote a couple of months back on, how to approach figuring out your investment allocation as a Fed in the TSP. If you need additional help and you're looking at it like, I really am not sure that I'm diversified enough, that I'm mitigating risk well enough in the portfolio, we're happy to talk to you here at Serving Those Who Serve. You can reach out to us at askstws@stwserve.com. We'd be happy to have a conversation, see if we can help with that. But bottom line is, if you are a C fund proponent and you've got everything in that C fund, I know it's been looking good. I get it, baby. The Shiller PE is 35.5. I know it's been looking good. The concern is, how long are we going to keep looking good?
Right.
And how long are we going to run those odds, knowing that there is this pattern of following those peaks in the Shiller PE, a prolonged pullback? So just a little word of caution there. Make sure that we're diversifying. Make sure we're not putting all our eggs in one basket. And, check that out. If you are, really into kind of the technical analysis, I do recommend checking out this article on our blog, really getting into it. This actually was a piece that was contributed by our co-founder, Tom Lee, and he loves to talk about this and he can really get into the weeds on it. And we're happy to have him put this piece out for our readers, because we do think it's really, really meaningful and impactful. So
couldn't agree with you more. And I think that's all the time we have for today, folks. But have no fear. We will be back next week to bring you the latest updates you need to make informed decisions about your career and financial well-being as a Fed.
Absolutely. And to make sure you don't miss that episode, subscribe to our podcast on our YouTube channel, as well as on Spotify, so that you never miss an episode. And please do share it with your friends and colleagues. I know that some of you guys have that guy in your office who is the C fund evangelist, who's always telling all you guys to put all your money in C fund. Send him this episode.
Yep.
Help them learn about the Shiller PE ratio. I'd be happy to talk with them about it. So share it around. It really does help.
And for more information on these topics and more, check out our blog at blog.stwserve.com and subscribe to our newsletter, The Weekly Serving, so you'll get all our best stuff delivered straight to your inbox every single week. You don't have to go looking for it.
For sure. And those who want to dive even deeper into learning about federal benefits and financial planning for Feds, please do attend one of our complimentary webinars. We do really encourage folks to come join us. If you've never done a webinar with Serving Those Who Serve, please do consider it. We've got some good sessions coming up for CSRS. We know that there are fewer of you than there used to be, but we will be with you until the very last CSRS retires from service. And that webinar is going to be on October 22nd from 11 a.m. to 2 p.m. We've also got a session coming up on FEHB just ahead of open enrollment season, October 23rd of this year, 10:30 a.m. to 2:30 p.m. I know it's a big time commitment. I know that there's a lot of information.
No, it's not. It flies by.
Time flies when you're having fun. It's a big time commitment, but there is a ton of information to cover. FEHB is one of the topics that we get the most questions on. So please do consider attending this webinar. Dana's hosting both of these, by the way. So, you can join and drop a bunch of feedback for him in the Q&A on the podcast.
Absolutely. Alrighty, folks. Thank you so much for listening to the Fed 15. I'm Dan Sipe.
And I am Katelyn Murray.
And we will see you next week.
See you next week.